State Bank of India has reported a standalone net profit of 3581 crore rupees in Q4, aided by a one-time gain of 2731 crores from the stake sale in its subsidiary SBI cards. In our ideas for profit today, I will discuss if investors should bet on State Bank of India's low valuations. Well, SBI's operating performance was marked by a reasonable loan growth and also controlled expenses. However, higher provisions pulled down the profit this time around. On the asset quality front, the slippages, or say the gross additions to the non-performing assets or NPAs, were quite contained and were the lowest in the last 4 quarters as well. But should SBI's downward trending NPAs be a matter of rejoice, knowing that COVID-19 is likely to hit hard the asset quality of the entire banking sector? Why should investors really consider SBI at all right now? Well, COVID-19 will definitely add to banks' asset quality woes and also impact its profitability. However, SBI is well equipped to weather the storm given the sheer size of it. The balance sheet of excess of 40 lakh crore rupees as at the end of March 2020. SBI's advance book also grew by 6% year on year and also driven by a lot of loans. The domestic loan book growth was also slowed further to 4% year on year, but the overseas advances growth of 18% year on year supplemented the overall loan growth. Now, banks' advances under the moratorium at 23% of the total loans are also relatively lower when you compare it with many other peers. SBI was able to also maintain the low-cost current and savings accounts deposits or CASA at around 45% of the total deposits and has gained a market share in overall deposits as well as CASA deposits. Now, despite the overall loan book growth, the net interest income declined as the domestic net interest margin contracted to 2.94% in Q4 FY20, which is a decline of 8 basis points year on year. Now, NII was adversely impacted by higher interest reversals due to the slippages in its agri lending book as well. Now, despite the broad-based slowdown, SBI's retail loan grew by 15% year on year, which is quite encouraging right now. Corporate advances were almost flat, while SME segment saw 7% fall in loans outstanding. Now, deposits growth at 11% year on year was ahead of the advances growth as well. Controlled operating expenses has also been the key strength of the bank so far. The key positive for the bank is the high provision coverage ratio, or the PCR, which stood at 84% at the end of March, improving by 489 basis points year on year. Interestingly, SBI has not created any specific COVID-related provisions, unlike many other banks. While this is also concerning, we do know that monetizing the stakes in the subsidiaries can really help the bank meet the higher provisioning needs. Now, SBI enjoys healthy capitalization, strong liquidity, and can also raise additional funds by selling stake in some of its valuable subsidiaries going forward. Well, at the current market price of say 189 rupees per share, the valuation of the stock at significantly below FY22 estimated core book value. So that is encouraging, and buying SBI stock at this price is perhaps getting the valuable subsidiaries right now for free. Now, that said, the stock can remain highly volatile due to the uncertainty of COVID-19 and cannot emerge unscathed from the ongoing macroeconomic slump. Nevertheless, given the low valuations, the country's largest bank is worth a bet for long-term investors waiting to play on the economic recovery cycle.